welcome everyone to this month's edition of the Minding Your Business newsletter. As a reminder, this is the newsletter that we put out each month for business owners and the advisors that serve them. And my name is Andrew Connors, and I'm a managing director here at Fairport Wealth, and I chair our business owner practice group. And so I wanted to share an interesting statistic. There are over 11,000 private equity firms in the United States. That is a lot of private equity firms. And so we have had a number of clients over the years partner with private equity firms, sell their companies to private equity firms. And I think it is interesting. As many private equity firms are out there, there's probably as many wealth managers. And if there's one thing that I know, they're all not created equal. And so what I thought would be a really helpful topic for discussion today is to pull back the curtain and kind of demystify private equity. So I've asked Cheryl Strom, who's a good friend and a great professional.
Thank you.
She is a partner at Riverside, which has a 36-year history of private equity. And she herself, I think you've done $3 billion in private equity transactions. So you
That's
have
right.
you've done it all, more or less, and you've done it all a lot. And so we invited Cheryl to come in today and just kind of share her insights. We're going to pick her brain and, again, demystify private equity so that we can better understand as owners, how might this be a resource and what does that look like? So to kick things off, a question I have for you, Cheryl, is why does private equity create such preconceived ideas, emotions, and whatnot among business owners?
So I think because there are some negative stories in the press that going back folklore even, the very first buyouts that involved corporate raiders using 90% debt, firing a lot of people along the way and sometimes destroying value. Riverside is a different firm, and I'm fortunate enough to see so many peers of mine who are doing an excellent job at helping small and medium-sized businesses grow. But I think the emotional stigma that accompanies sometimes a lack of understanding can be that it's just an emotional topic to sell a company.
Yeah, it's definitely emotional. Definitely emotional.
So the beauty that can come out of a private equity transaction is bringing in the resources to help a company reach its ultimate potential and grow and become even more important in its end market and solidify a position of leadership and expand. That is when everyone is doing their playing their part in the orchestra properly, and something I'm really proud to be a part of as a part of the private equity industry.
Awesome. So we've been in this situation where we've been working with business owner clients before, and they might have an investment banker they're working with who's gone out and marketed their company, and they have a number of different private equity firms that they're considering. And usually one of the things that they're always focusing on is the structure of the deal, which is important. But usually that focus just is how many dollars are at play, what am I potentially putting in my pocket? And I think if you're looking to partner with a private equity firm, that's an important piece, but short-sighted in terms of doing due diligence. So a question I'd love to hear you share your thoughts on is, as an owner, you're sitting in that CEO founder's chair. How do you do due diligence on the private equity firms that you're looking to partner with? So you might have 3 different firms out there. How do you figure out which one's one for you?
Well, it's a great topic, and the focus of these transactions does tend to be the buyers doing due diligence on the company, and it absolutely is important, as you bring up, for that CEO founder to turn the tables and do due diligence on the potential buyers, and a good advisor is going to help do that even early on, and in qualifying the parties that are invited to begin with to even consider that opportunity. But the very first thing that I would say is a self-examination of due diligence, which is, what are your objectives as a seller? Is it your goal to sell 100% of the company and day one, post-transaction, to go to the beach and truly never want your phone to ring again, hearing about the business? we don't meet a lot of business owners that is their objective, although we certainly can take care of a business owner who maybe has already departed, from day-to-day roles of the business and lives in another state, and it simply wants to realize, put great people in charge and wants to realize a 100% liquidity event. But very often we're finding founders and owners who are still young. I consider people in their 40s and 50s quite young, Andrew.
Thank you.
And that what they're looking to do is say, I've achieved something beyond my wildest dreams. I'm very often talking to business owners who they founded a company 10 or 15 or 20 years ago, never thought it would be more than 2 million in revenue. And here we are at 25 million in revenue or 50 million in revenue. And now they realize, wow, this could be a 100 million revenue business. This could be a 250 million revenue business. But we're starting to get into some core competencies that are maybe beyond the daily experience that I have.
And I was going to say, that's something that I see is that getting to that, whatever that is, usually it's something in the 25 to 50 million revenue range, is one type of skill set or growth pattern. But it's that whole mantra of what got me here isn't what's going to get me to that next level. And so what resources, so if I'm thinking about Riverside, for example, saying what resources can they bring to bear to help me scale my business to get to that next level? And what do you see as hurdles that business owners face in scaling their business to get to that next level also?
Well, that question you asked, Andrew, about the resources, that's exactly the due diligence, that the founder should do on the potential private equity partner. And I guess the first step, the self-diligence, is what do I really want? Do I want to run this company for the next 5 or 7 years alongside additional resources? Or do I want to transition leadership to someone else in a couple years? All of those companies can be solved. And typically the private equity firm's response, if they have good experience and they're good at what they do, is going to be, you tell us what you'd like, and we will help you achieve that. We really do want to help people achieve their dreams. But if the goal is to stay in the seat but surround themselves with more resources, how do we go about doing that? One, we very much have a mindset of helping the company grow. And that's the total focus. And we want to do that with, one, the existing management team, ideally. Our particular firm is not coming in to take over and change. We don't have people sitting on our bench.
And I assume if you're Riverside or any private equity firm for that matter, and you're coming in and looking at a company, if you're looking at that company and thinking, we need to put a whole new management team in place, that's not going to be an ideal situation.
It isn't an ideal situation. It can be addressed if that's what the task at hand is. But that typically is a different type of investment. And we actually do have one fund that's devoted to operational improvement opportunities. Maybe it's a carve out where there really isn't a management team coming along, and we can help and address that. But if we're working with, say, we have several funds that they really are investing in businesses in their end markets. They're already growing, but there's an opportunity ahead to grow even further. So I think the resources that the owners need to seek out, and often things that we see, it's hard, for existing management teams and founders to take these steps, are having the capital and the experience to say, we're going to hire, 10 or 15 salespeople. We're going to add 2 or 3 important key roles to the management team, and we're going to give those people equity upside in.
Do you think owners, because the financial, there's always 2 themes that come up, I think, whenever we chat, and it's always financial capital and human capital. And so do you think it's because owners, especially if they're in their 40s or 50s and they're at a point where they might say, I'm not sure how comfortable I feel injecting a lot of my own capital back into the business? Do you think that's a keep people up at night thing? Yeah. And then is it, I think the talent wars, for lack of a better word, frankly, is whoever wins the talent wars wins, period. And it is hard to hire great people. So when you talk about bringing on 10, 15 new salespeople, if I'm an owner, I would think, oh my gosh, I just don't know if that's even within my bandwidth to be able to source and hire and manage 10, 15 additional salespeople.
Right. I think to your point, so one, I think the business owners have been through some really tough times, in the past 3 to 5 years, and have seen, the unexpected turbulence in their end markets and are somewhat reluctant to spend on growth. But we know it's needed. In fact, one thing that one of my portfolio company CEOs told me recently is that having an investment from a private equity firm helped me hire and spend money during times when peers of mine were cutting back and didn't have the ability to sort of prepare for these industries to rebound. And so that's something, again, that we're confident and experience bringing to the table. But I think business owners sometimes hold off on those hires because it's money out of their pocket, as maybe they believe that they're in, the ninth inning, so to speak, of their personal expenditure on the business and are looking for a significant realization event and don't feel that it is the time to spend on the business. Whereas what we're going to say is, wow, we are starting an investment period today. 5 years from now, we have a vision for the company and we want it to be this big, which is, significantly larger.
A multiple of whatever it is today. Right.
And in order to get there on day one, we're going to start on this expansion plan. And the people who we have the best partnerships with are founders and owners who also want to get there and want to play a role in getting there, but are willing to share the responsibility and the strategy and planning with a party that can help them do it right the first time.
So you and I were talking at one point and you said something and it always kind of struck me. Like you said, when you're thinking about private equity firms, they all come to the table with dollars. And all dollars are created equal, but the resources they bring are not.
That's exactly right, Andrew. And it's private equity funds do all tend to look the same, as people look with an outside lens. What I've seen happen at my firm over the past 18 years is the significant expansion of talented people who are helping direct the strategy and expansion at our portfolio companies.
What do those people look like? I'm curious.
Yeah. Well, you can look at some of the profiles even on our website. We have operating partners. We have sales excellence professionals who this is a newer discipline that we may have even introduced to the industry. People who have experience operating companies with a laser pinpointed experience on the sales team. So often we invest in companies where the chief salesperson is the CEO and founder of the company.
Right.
But there isn't necessarily a sales team around them. And there are opportunities ahead to expand that sales force.
Is it fair to say that you're often coming to the table with an advisory board that has subject matter experts in different areas that are industry specific, for example, that an owner can look at and say, oh, this person has software or technology or specialty chemical, whatever experience. And then there's people with sales experience that can come in. These are all these, call it minds that you can tap and have as your ad hoc advisory board, essentially?
Yeah, so great analogy. All the resources that we have at Riverside are dedicated professionals to our portfolio companies. Very often they're spreading their time out over 4 to 6 portfolio companies. Okay. And the good news is for business owners, especially those who want to stay active in their business, we have no desire to come in and take over and run the business. That would actually be not as how we want things to play out. But we do want people who are peers and who have also been in seats prior to their time with Riverside, where they have successfully run and grown small and middle market sized businesses. So we are going to involve 4 types of resources. 1, an operating partner. 2, a sales.
Define operating partner?
Sure.
So for everybody who might not know what that means, what does an actual operating partner mean?
Yeah, this means, I particularly have a background in finance, and a lot of my colleagues on the investment professional side, we have experience running financial models, forecasting, looking back at financial performance, dividing up revenue by segment. That's the common stereotype that business owners are used to encountering.
Right, exactly. They're thinking number crunchers, spreadsheet people.
Yeah, and that is an absolutely important capability. But we have found that we need to augment that with individuals whose background is in engineering or software development or marketing or distribution center expansion and integration.
And a lot of these people are usually former business owners, I'm guessing?
Yeah, they're either former business owners or former CEOs, COOs, people who have maybe run a freestanding division of a public company and have a track record getting a company from 10 or 20 million in revenue to 100 or 150 million in revenue. Or typically not bringing in people from Fortune 500 companies who sort of just don't have experience on the ground,
right.
But people who are peers to the sizes of
people who've gotten their hands dirty, so they can have a peer-to-peer conversation with an owner of a company you might be acquiring or have acquired, for example.
Exactly. So the operating partner resources, sales excellence professionals are very similar to the operating partners, but with a laser focus on sales, marketing, and demand generation.
Gotcha.
Three, our toolkit providers are actually an array of resource providers that we bring on an on-needed basis. It might be we've got to focus on pricing, or we've got to focus on how do we incorporate AI in our software offerings, or we're going to be doing an ERP implementation. That we want to bring someone to the table who knows how.
Everyone
to do that.
loves ERP implementations.
Someone who knows how to do that right the first time is critical. In helping a business maintain and grow its operations. And then the fourth piece of the puzzle is capital that's in our funds to make add-on acquisitions, and the people on our team whose is finding, doing due diligence, and closing those add-on acquisitions.
And I think that's kind of an interesting point, because as business owners, there's a lot of us who think inorganic growth through acquisitions can play a meaningful role in scaling my business. Mm-hmm. That is not an area a lot of people have meaningful experience with. Mm-hmm, and so I think being able to bring that kind of thought leadership to the table is a big deal, because getting a deal from first all the way around home plate and scoring that win takes a lot of experience.
It sure does. I mean, there's just sort of nothing more, fulfilling than, helping a management team of a company that has fought for sometimes years and years about making add-on acquisitions, but they haven't done it yet. And one of the reasons that the ownership team has brought us to the table and completed an investment with us is so that we can bring those resources to them. We have portfolio companies that have ranged from completing 4 or 5 add-on acquisitions in a 5-year period to one that is setting a record, having made 24 add-on acquisitions. And what happens is we're always asking the management team first, does this make strategic sense? But where we're coming in with the resources is helping them complete and close that acquisition with resources that you don't necessarily need on your team every day, but you need to really run at a fast speed at that period in time when you're doing due diligence on the add-on, bringing it to the closing table, and then developing an integration playbook, because at every add-on acquisition, it's so important to get it right, from a cultural fit to what happens the day or 2 or a month post-close.
So let me ask you another question. I think where a lot of uncertainty lives with business owners is, I sell my company to a private equity firm. What does that first 12 months look like? And the uncertainty lies in, are they going to tell me how to run the company? Are they going to tell me what I can or can't do? And so for business owners, having a sense of control, having both hands on the wheel, so to speak, is really important. Mm-hmm. As an owner, do I still get to keep both of my hands on the wheel? What does that look like, let's say, the first 12 months once you move forward? Well,
in the perfect world, nothing changes, especially when we're investing in a company that's already been run really well. What does change is the supplemental availability of resources to achieve that growth plan, and probably a bit more of a faster pace that everyone will agree upon before we close the investment. It's kind of, what are we going to do together? What is this going to look like?
If you start off on the right page together, then everything else kind of hopefully falls into place after that.
But I'll tell you, I've spoken with CEOs of our portfolio companies about this exact topic. What happens post-close? What were you afraid of? What actually happened? And things that I've heard from our CEOs included, one, it was still my company to run. I just had more someone to go to help me make tough choices, to help me make good decisions. We're going to put an outside board of directors in place. We're going to have quarterly board meetings that will be a decision-making body affecting spending, of a certain amount, a couple $1 million and up. We'll probably want to weigh in on that spending. And 2, I've also heard that I was able, as a CEO, to expand my business.
Question. I think there's a perception that private equity firms have a very short-term time horizon, like 1 to 3 years. Mm-hmm. And so what a private equity firm that you're ideally going to partner with, Riverside, for example, or someone else, what should be an appropriate time horizon? Because making sure that, if you want to do add-on acquisitions, expand the management team, all these toolkit types of things and resources you can bring to bear, what time horizon do you realistically have to be able to scale that business and realize the benefit and outcomes that you want to get?
Right. We think that 5 to 7 years is a good amount of time to achieve some really great strategic improvements in a business. The reason for that period in time is to satisfy our investors. We're investing on behalf of parties that are patient, but that do need their capital returned. We can't own our portfolio companies for 20 or 25 years,
right.
Because as I mentioned earlier, we're not pulling capital out on a quarterly basis. Sometimes the downside of a long-term hold fund or a forever fund, it might be comforting for an owner to say, hey, now that I've done this deal, no one's going to sell this company for 30 years, but they might be taking capital out of the business every quarter to meet their investment objectives. We're actually not. We're leaving the company, the cash intact that the business generates, because we want them to spend on growth, but adding people, maybe even funding some of the add-on acquisitions, and they can supplement that with the capital from our fund. We think a 5 to 7 year period is a good period of time. It's a great question to always ask. There are lots of different time horizons that are in place at different types of firms that have different sources of capital than we do.
Awesome. I think we've kind of scratched the surface a little bit. We could spend a lot more time talking about this. Is there anything that we missed that you say, oh, we should definitely talk about this?
Well, I think that it's important for business owners to think about the character and values of the firm that they choose to allow to invest in their business. Everyone is always concerned about price, and am I getting my highest price? And what I found noticing the 18 years of investments that I've seen firsthand is that price does tend to work itself out. A handful of different parties are all working on something, and the right price is going to emerge, and people are going to match it. But knowing that the people that you're choosing to allow to invest in your business have long-term values, and you can prove it and touch it and feel it, that they're treating people well and actually achieving success for your employees and team members, that's what's important.
I think you just hit the nail on the head. That's what you want to look for in your due diligence.
Yeah.
Thanks for sharing all of your insights and everything.
Thanks for having me.
Hope everyone found this valuable. At Fairport, we're always here to be a resource for business owners, and Cheryl Strom at Riverside is always a great resource for business owners as well. So thank you everyone for your time. Hope you enjoyed this video and found it valuable. Hope you can make it on October 18th. Invite to follow.